Hello and welcome to this week's episode of Nucleus Investment Insights. Today we ask the question, are NVidia and AI stocks in a boom or a bubble? NVidia has been on an absolute tear as it's a supplier to the burgeoning AI industry, as have the tech stocks that actually provide the AI technology. We and a lot of the rest of the world like NVidia because it supplies the AI industry. There are going to be winners and losers in AI software, just like any new emerging technology. But we are confident the industry as a whole will grow over time. This makes suppliers to the industry like NVidia attractive. We're going to dive into the eternal questions of any fund manager. What's the stock worth, and is there more upside to come? Today, as always, we have Damien Klassen, Nucleus Wealth's co-founder and chief investment officer. Damo, welcome.
Hi, Sam.
My name's Sam Kerr. I'm the senior financial advisor at Nucleus Wealth. Just a reminder, the information in this podcast is general advice and does not take into account your personal situation. If you do want to discuss your personal financial situation, please go to our website at nucleuswealth.com and you can book a call with me to have a no obligation chat. We are live every Thursday at 12:30 Australian Eastern Time. So jump onto the Nucleus Wealth YouTube channel and you can ask any questions that come to mind and we'll do our best to answer them during the show. You can also follow us on your preferred podcast platform as our show is available on all the majors. So that's all the housekeeping, Damo. So I'll hand over to you to get the ball rolling.
Thanks. So NVidia. Touched briefly off $1 billion back a fair bit last night, but it's the big story, and there's a whole bunch of other stocks as well related in terms of the AI that have all been on a pretty big run since NVIDIA made this announcement and upgraded its sales forecasts last week. And so what we really wanted to do is just sort of touch on that, I guess, how you can play in the cycle, what some of the numbers are, and I guess the thoughts behind investments in this sector and what it might mean. It's a very interesting test case in terms of trying to work out where's the value in terms of AI, and we've done a few different podcasts on AI, and one in particular where we dug a lot into the background behind it. So I'll only just sort of touch briefly on our outlook, and then we'll sort of follow. I guess if you want more detail, there's another podcast out there you can jump on from about a month ago or so. And so the big picture really is that we're treating AI much the same as sort of the introduction of the internet or the introduction of personal computers into organizations, in that there's going to be this huge productivity gain as a whole bunch of people get easy access to something that was otherwise hard to access beforehand. And so and that's going to create significant productivity gains for a lot of people involved. Our take was that it was going to be that a lot of the benefits were going to accrue sort of across the price chain, and that you sort of had to watch from between different industries where it would accrue to different areas. Sometimes a lot of it would accrue to the workers within that sectors. Often, though, it's probably going to accrue to the companies who are getting productivity gains and not needing as many workers behind that. And so, so lots of different people coming out, but let's sort of go to NVIDIA and what's happened. So I've got a chart just sort of showing from Bloomberg, just sort of showing the NVIDIA versus Intel and AMD, which are the other two big chip makers. And you can see there's well worth, even this was a couple of days ago before it sort of touched off the $1 billion mark, but it's worth way more than AMD and Intel put together.
$1 trillion mark, Damo.
Yes, $1 trillion mark. Sorry, $1 trillion mark. Those two have got, in particular, Intel, significantly higher sales. And then there's a question about, how valuable and how important the NVIDIA chips are. Short sellers have been taking a big bath. There's some stats out sort of suggesting they've lost, $8 billion in losses, and so potentially there's some short sellers that might cop it on NVIDIA. The valuation wise, it's quite expensive, and so that's where we wanted to jump in. What's justified, what's not justified, how big can this market be, and what are the pros and cons, because it is a really interesting test case. So the first thing is, that what really sparked it was they've got a sales to data centers, which is sort of one of the measures, and they basically doubled the sale. They're expecting the sales to data centers to double over the next 90 days. So very impressive growth to be able to double your sales to one of your major market or your biggest market segment in 90 days. And the question is, how much growth is behind that? What's following on, and where's that going to, and where does that lead? Is this permanent increase? Is it a short-term increase or whatever? So that's a big positive. A few months ago, we had a China ban come from Biden. So some of the high-end NVIDIA chips and a lot of the best AI chips that they've got are banned from being sold within China. And so China's out there trying to create competitors and trying to create other chips themselves that are doing it. It's worth noting that they are certainly the industry leader in terms of this space. They sort of started from graphics chips for gaming, and the benefit of graphics chips was the types of calculations that you do to show realistic gaming screens are actually very similar to the types of calculations that need to be done in terms of AI. And so what that meant was there was quite a they already had a skill set within the business that could quite easily transition across, and they created a lot of these AI chips very early in the game, and now really reaping the benefit in terms of being very far and away the industry leader. And I think and getting massive market shares within that market as well. And one of the key things though is that it's not just a hardware solution. What they've really done is built sort of the systems and software around this, so that people who are looking to sort of integrate this into their machines or integrate this into their work processes or whatever it is, have this whole suite of software and elements around it that really make NVIDIA put them in a sort of market leading position, and hard to catch up, because the others have to build not only build the hardware and everything around it, but also actually build this whole ecosystem. But another factor though that feeds into it is they don't actually produce the chips themselves. So it's not as if they're sitting here with this wondrous. So they're designed and they've got all the chips sort of down, but then most of the chip production actually gets done by Taiwanese semiconductor manufacturing company, so TSMC. And so that there's somebody, if somebody else can come up with a similar design or crack some sort of design mode, there's somebody who can make it really quickly. You've got this major company out there that's actually doing the production of it. So it's not as if if you're thinking about what's NVIDIA's moat, the actual production side isn't. It's the design side and the other parts that go behind it. So so it's sort of sitting in this really interesting sort of position with sort of positives and negatives. The other thing you get is that the earnings from some of their other sectors haven't been as consistent as what you might like from a what you call a high quality company, and some of that's been bounced around by the cryptocurrency. So I've got a chart table just up showing some of the revenue by segment. Don't worry, that's sort of just breaking it up into sort of their main sort of 5 different areas of gaming, data centers, professional visualization, autos, and OEM and other. And the issue you've got within this is that they were a big supplier of gaming machines, or gaming, the video card within gaming machines that cryptocurrency miners were then using to mine cryptocurrency. And in sort of late 2023, Etherium went from what's called proof of work, which was basically going out and do these complicated calculations, and we'll give you some Ethereum, to proof of ownership, proof of stake, which is basically cut the electricity needs and the processing needs down by sort of 99+% in terms of the amount of work that was actually need to be done. And the idea behind this was exactly this idea that, you know, Bitcoin faces all the time, is it uses the electricity of a small country basically in wasted doing useless calculations to prove that you've done the work in order to get some Bitcoin. And Ethereum sort of went away from that and went, okay, rather than doing that, we're going to go to this other model. Now, NVIDIA chips don't get used for Bitcoin broadly. They're not the Bitcoin's got this this particular type of calculation and constraints that meant that NVIDIA chips weren't ideal for it, so they never really got used for it. But they did get used for Ethereum, and that's why the gaming sector, we sort of went from $3.5 billion worth of revenue per quarter, fell to, you know, by the third quarter it was back to 1.5. It sort of bounced back again to 2.2. But, you know, the question is, when you've got a company that more than halves its division, you know, how much of their revenue from that gaming was really just crypto mining, and in particular Ethereum within that. So you've got this extra component of, you know, that's it could have easily been, and nobody really knows, and they actually got fined for not disclosing as much as they should have. And they were trying to stop people from using their chips to actually do Ethereum mining, because they wanted to sell it more to gamers and other people use it for more legitimate purposes. But then people would hack it and use them again. And because they had the sort of market leading chip, that was what led. So they probably, you know, for a company that was making, you know, 25 billion-ish in sales, it's possible that at least 5 of that, maybe as much as 10 of that, was coming from crypto mining. And then that sort of disappeared. And that's where we saw the share price tank last year as all the Ethereum, as that sort of flowed through, and because nobody really knew how much was done, and even NVIDIA themselves wouldn't have known, you know, what people were using the chips for once they were buying them. And so so that's sort of sitting on one side. If you look at some of the other parts, for professional visualization, well, that actually fell. That sort of cut by 60 or 70% as well over that same time period. You know, auto's been increasing, but it's a pretty small part, and the OEM stuff actually had some specific specific crypto chips had made that never really caught on that well. They probably sold a couple $100 million worth. But yeah, the net effect, crypto has really changed what's been happening with this company. So at the moment, it doesn't look like they're going to benefit that much from crypto. Maybe what you could see is that, you know, maybe one of their future chips and Bitcoin will be, you know, more compatible, and you get a lift from that. But the flip side is maybe you get just more and more cryptocurrencies moving to proof of stake rather than proof of work, and maybe, you know, where their profits are now might tail off a little bit further as some of the rest of the other, you know, it's still NVIDIA chips are still useful for some forms of crypto. It's just not the main ones. So, you know, and Ethereum and Bitcoin were the two main ones. So that's sort of the, you know, what's been going on with that segment. So that's sort of, you know, a flip side to a negative. But, you know, as you can see from these numbers, they sort of grown their data centers from $3 billion, you know, a year and a bit ago, and sort of just gradually increasing every period, and this jump from you know, $4 and a bit billion in the latest quarter to over $8 billion they're expecting in the next quarter. Okay, so that's a little bit more background. The other background I should give is just on competitors. And so within this, you know, it depends upon which space you're talking. Within the GPU space, so the graphics processing unit space, AMD and I've said maybe Intel. So Intel is a huge competitor in that space. But you know, who's capable of doing the AI stuff? So AMD, yes. Google has got its own specialist chips that it's trying to introduce. So does AWS. So both of those do use NVIDIA in places but are trying to get their own chips. Apple's trying to develop its own chips and has that for some of these AI calculations. So, I guess there's 3 of the 4 biggest companies in the world are also out trying to hit this space as well. So NVIDIA is clearly the leader, but has competitors. And Google and AWS are 2 of the biggest data center providers. And so while they are using NVIDIA chips, you would think they have a predisposition to using their own chips if they can get them to a certain level, and that there's a very, very real risk that in short order, you could see the Google and AWS switching if they hit the right constraints. The other thing to note is that it is good to sell to gaming. Gets you good revenue, gets you a good margin within gaming. Generally speaking, you find that data centers aren't as profitable for equipment manufacturers, because some of the bigger ones, or they tend to buy in bulk, and they tend to be less concerned about the latest specs and more concerned about real value for money, because they are buying all the time. Everything's very data driven. So as an example, if I'm buying my latest gaming rig and I can buy an NVIDIA chip that's 20% better than everyone else's, and I'm spending $3,000 on my gaming rig, and the best NVIDIA chip's going to cost me an extra, an average GPU is costing me $500, and the NVIDIA one is going to cost 3 times that. And I might go, oh yeah, well I'm already selling out 3,000. I'll make it 4,000. I'll get the best gaming, the best chip I can have. And it might be, as I said, 20% better, 30% better than anyone else's. And as a gamer, that might be worth it to me as the cost of my overall rig. Data centers don't think about it that way. They're very, very driven by cost. If your chip is 20% better than everyone else's, they will probably pay you roughly 20% more than what they pay everyone else. The question is for a data center is saying, well, if I need 4 of your chips or 5 of the other chips to get the same result, well, probably going to, it's now a price contest. If you're going to charge triple everyone else, I'll say, well, that's fine. I can add, I'll be able to add 10 of the other machines to every 4 of yours, and I'll still be in front, and I'll have more processing capacity. I just need to work out how to farm it out. And so, so I guess where I'm getting to is, it's great to be growing data centers, and that's clearly an area that you want to be, you really want growth in. And there's a short-term impetus where I think there's going to be a lot of switch to AI, and it's obviously caught the zeitgeist of the IT world at the moment, and the business world. And there's going to be lots of people demanding, we need to be able to put artificial intelligence into our press release. How do we do that? So let's spend some money. So there will be a beneficiary of that, but the question comes back to how much of a beneficiary, and that's where sort of I want to jump into and sort of work through that sort of some of those thoughts as we go through. And before I sort of get away from the background, so I just want to talk about the cyclicality of the sector as well. So it is a very cyclical sector. I've got a chart up of some chip cycles that's just showing that it's over about a 20-year period. We've had sort of 4 big downturns in that time, but umpteen little ups and downs. The orange line at the top is the unit sales, and the blue line at the bottom is the actual dollars of sales. But it's cyclical, and when your sales are so cyclical and change in a big way, your profits change in a much bigger way as well. So if we look at, and I picked 2 of the bigger ones out there. So Intel, which for the last 20 years, for 20 of the last 25 years has been the big leader in central processing and a whole range of other factors. They certainly haven't been the leader in the last few years. But so as the biggest player, you can see that 2000 was pretty profitable for them. Then they were losing money for 2001, basically through 2003. then they're back to making money, then they're back to break even. Then they made a little bit of money before the financial crisis, put them back into loss making. Then they were like up a lot, and then profits fell, 30% into 2015, and then they more than doubled from there, and then they're down 80%, over the last sort of year or two. So it's a wild ride. It's not and that's your biggest player in the sector. And if you looked at Intel in 2000, like they were effectively the new big leader, and they were the ones that were going to be taking over and had this rosy future. And even despite that, and despite market leadership for most of that time, their earnings have been really, really cyclical. Then you jump to Micron, which is one of the leaders in memory chips. So quite different, but in a similar, quite different in terms of, it's not a direct competitor to NVIDIA, but very similar in terms of it's exposed to similar cycles, and its profits have just from year to year, it's had, well, in the last 20 years, it's had 4 or 5 cycles where it's dripped into negative, and very common for its revenues, for its profits to rise 1,000% and then fall back down 99% and then rise again, and doubling and tripling is a doubling and halving of earnings is like a mild cycle to them. Like it's usually much bigger in terms of the swings and roundabouts. And that's because what tends to happen in this sector is that you get a lot of investment, you get some price signals that chips are high for whatever it is, and cars can't get enough, and everyone rushes out to build factories, and then all the factories come on at the same time, and there's this excess of chips. Or you produce the greatest generation of chips at the moment, and then as you're in a year and a half, your competitor comes out with something slightly better than you, and next thing you go from selling having a 60% market share to having a 30% market share, and then and it sort of cycles back and forth. So as a big picture, it's a volatile industry that you're in. So let me just take that all the way back now to sort of recap what we're looking at for NVIDIA. So great company within what it's doing. It's got market leadership. It's huge market share. It's been early into data centers and early into AI, and really established a leading position. So it's in the box seat in terms of that. But it's in this industry that's really, really cyclical. It's in an industry where in 4 or 5 years, companies can lose leadership, and quite dramatically. And we've already seen within its own part, that it's had some really big swings in terms of just in the last year in terms of profitability as crypto went out of fashion, or you can see similar things could happen again. They've been very volatile in terms of their own sort of earnings. So yeah, how do you put that all together and give it a price? So just to put that in perspective, they're trading on about 45 times earnings at the moment. If you go another year out, you can probably bring it back about 35 times. That's on consensus numbers. Having said that, consensus is all over the place at the moment. So if you were really keen about the growth of this market, you could, it's looking to double its sales in one division in 90 days. Like, can it do that again a couple of times? Can it? If it can, then that PE will come right back to an ordinary level really quickly. It's really hard to do comps at the moment because, as you might have seen on some of those other graphs I showed you, the numbers have actually, we're in a bit of a winter for the semiconductors, and so all the profits are really are right down at sort of cyclical lows for most of their competitors. So what tends to happen is, across a broader cycle, these things will trade on somewhere between 10 and 15 times price to earnings ratios. So the market might be trading sort of 15 to 20, and these things will be trading usually at a discount to the market because they are so cyclical and they are much more volatile. So, but then you go, well, you look at, say, when they hit their peak cycle. So Micron, when it hits its peak cycle, it might be trading on 2 or 3 times earnings because everyone's looking at their earnings going, okay, you just made $10 a share, but we know that's not sustainable. We know that you're at the top of the cycle, and we know that at the bottom of the cycle, you're going to be negative. And that's exactly where they are now. So they've got a negative PE because they're sort of sitting at the bottom of the cycle. So it is very hard to do a comps, but I guess what I'd be looking at is, can you see a through the cycle sort of earnings of 10 to 15 times? And why it's at a discount to the market is because you are going to get the this cyclicality, and you can lose leadership. The leadership gets lost. Every few years, you got to keep coming up with the next greatest and the next greatest, and so it's not as embedded in terms of, and the technology changes faster. So you do have this sort of rapid capex cycle you need to keep on top of all the time. You can't just keep living off your past hits. Whereas I think in some other industries, that's clearly can happen. So if you're a car manufacturer with a great brand name, even if you start putting out some dud cars for a few years, you can still get away with living off the brand name that you've sort of developed over a number of years. It takes you a while to get through that. Whereas in the chip sector, they're a lot faster, and particularly data centers are a lot faster to go. If your chip's not faster than everyone else's, then you cannot charge a premium. Okay, so that's valuation wise, but I might go across to you, Sam, before we start talking about where can we go. Where can these genuinely, how big is the market in AI?
We'll be back with the investment insights very shortly. Nucleus Wealth is an active and passive investment manager. If you like what you're hearing and want some help with your investing, we can do it for you via our active portfolios. Our tactical and core portfolios use the insights shared in this podcast to construct and manage your investment. We blend tactical portfolios to offer our combinations of international shares, Australian shares, government bonds, and cash. We vary the asset allocation with the goal of protecting your capital in times of market uncertainty. We also have active international and Australian share portfolios. These are chosen using our quality and value investment philosophy. You can find out more at nucleuswealth.com. Now back to the show.
Right. So what really matters for NVIDIA is how big is this market? And I've got a whole bunch of different ways that I'm sort of trying to look at this, so that you can, because I like to have the sort of the real back of the envelope type numbers. You need to dig through the numbers, make sure they're right. But if you can't make it work in terms of just quite simple calculations, then about sizes of markets and what people are spending money on, then your investment story doesn't really stack up. And when you're talking about growth rates about these, is like, well, if they just doubled in a quarter, well, what happens if they double for the next 4 quarters and then only grow by 50%, for the next few? You get these astronomical growth rates that'll say this company's worth more than every other company on the planet. And so, so really getting an idea of this market size is the key part. So there's a few different reports out that sort of run on this. What are we using it for? So at the moment, sort of most of it's being used for robotic process automation and computer vision, and so actually I might jump to this next chart of sort of showing this private investment by focus. So the interesting part, and I must admit I couldn't really get to the bottom of exactly why it's happened, but the 2021 numbers are actually a lot higher than the 2022 numbers. So we actually saw a big fall in terms of the amount spent on AI. Now, some of that might be companies who are I guess classifying it now as part of their ordinary business rather than trying to classify it as like this new AI thing that they're actually going to break out separately. Some of it might be that there was a lot of spend in 2021 and maybe some of the car makers and others were involved, but it seems pretty sector wide as well. So yeah, it's a little, and maybe what it was is that the whole there was lots of capital around in 2021 and a lot of easy money and a lot of capital raisings for startups, and so maybe that's where why we're seeing such a change. But medical and healthcare is the biggest one. Data management, fintech, all sort of making up the top part of the spend on that. And then you're sort of starting to get down cybersecurity, data protection, and sort of working your way through the rest of the sectors. But it's broad-based. There's a lot of different sectors involved, and a lot spent. If we put those sort of back into perspective about how it's grown over the last sort of decade, It's obviously much higher. We had sort of 120-ish billion spent in 2021, closer to 90 billion in 2022. So, how high can we go in terms of this spend, this AI spend in 2023 and beyond? So one of the first things I want to highlight is that China makes up about 15 to 20% of that. So we sort of need to cut that out of what's possible for NVIDIA almost straight away, or cut out a big chunk of that. In that China's not going to be keen, given they're cut out of the latest greatest chips. It's unlikely they're going to spend all their money on buying NVIDIA chips from 5 years ago in the hope that they'll catch up to what everyone else is doing with the latest chips. They're more likely to be spending a lot of their money on their own research and their own development in terms of the AI chips and things like that. So we sort of cut out the Chinese money. I think then you can. So that sort of brings you back to sort of 120 billion-ish. More like 110 billion. 110 billion in 2021. Probably back to 80 odd billion in 2022. So, I think if we call the starting point, let's call the starting point 100 billion, and then say, well, look, how fast can we grow? It's obviously captured everyone's attention, and we'll look at it from there. And the other thing I'd just like to highlight is, in terms of job postings, it's actually up to about almost 2% of job postings in the US now are for some sort of AI type job, and whether that's data science or various things that are sort of tangentially attributable. But it's the number of jobs out there has grown significantly over that decade. So I might and one other thing, and then we might I'll jump to you, Sam, for another message, and then we'll get into some of the calculations about market size. Is if you look at the companies involved, so there was 3,500 companies involved in terms of getting to those numbers. About 500-ish are spending over 50 million a year on it. There's a handful have been spending over $1 billion a year, and the bulk of those are spending under 50 million. But we'll use that to sort of put some rough figures behind trying to come up with some calculations. But I guess in a broad sense, we sort of need to keep in mind that yes, companies are going to spend lots on AI, but there's probably a limited number that are really going to spend the serious money on it, and there's the number of companies that can actually genuinely afford to spend $50 million say on AI is not that big in terms of there's a limits on the way down. Yeah. So anyway, I'll jump across to you, and then we'll put it all together after that.
We'll be back again shortly. If you like what you're hearing but want a low-cost passive option, Nucleus Wealth is the first to offer passive direct indexing in Australia. The first generation of passive investing was index funds. The next gen was ETFs. Now direct indexing is here with significantly more customization and control. The benefit of direct indexing is you can add or subtract investment themes, and we have almost 100 different options to choose from. For example, you could buy an international share direct index portfolio that excludes fossil fuels and arms manufacturers and has a tilt towards cybersecurity and cloud computing. Alternatively, you could buy a portfolio with no screens and an extra exposure to nuclear power and defense contractors. You can find out more at nucleuswealth.com. Now back to the show. Damo, I've just got a question. So on that chart that we've got up there, the two previous charts, so we see 2021 total companies 4,000, about 4,000, and then 2022 there's about 3,500 companies, which seems a little strange. You think with the growth in AI there'd be more companies year on year. So I mean, do you think have you got an answer for that?
Yeah, well, I'm guessing that what's happening is a lot of this is being wrapped into ordinary operations, and maybe some of it's being reclassified, but maybe some of it being a bit better reclassified. So it might be that somebody who had a couple of data scientists running around doing analysis, but not really that that AI focused, but the company would call it AI because that was the key to the part. There was a lot of capital raising in 2021, so I do think some of that was startup companies that sort of raised capital in 2020, 2021, and then probably ran out of money. There's probably a reasonable amount of those in there as well. There's not a. I don't have a great answer, and I don't know. From reports I've been reading, it's hard to pin down people on why there was such a significant fall in terms of from 2021 to 2022.
Yeah. Okay. Well, it seems like a pretty plausible answer. I thought I might have stumped you on that one, but as always, you've got a good explanation.
Yeah. So let's have a quick sort of go at a market size then from this. Is you go, okay, so we're starting with that either 125 or 90 billion. We're deducting most of China, and you come back to whatever 100 billion-ish. And you say, okay, well, how about if we went to 300 billion in short order? So we basically tripled the size of the market in a short period of time. So the real question for this is, and particularly in particular for NVIDIA, is if somebody's going to spend, say, $1 million, you've got a company and you're thinking, you know what, this AI I think sounds pretty interesting. Whatever we're doing, we might be making widgets and we think we can use AI to design it better, or whatever we're doing, where we've got a we're a shopping center and we want to use AI to recognize what people are scanning so they don't steal as much and all that. I'm going to spend $1 million. What am I going to do with it? The bulk of that money, as far as we can tell, is going on salaries. So, I'm going to spend $1 million. I'm going to stick on 3 or 4 data scientists at $150,000 to $200,000 each, and they're going to run all their tests, and then they're going to set things up, and then they're going to run it on the hardware. And so, if they're spending $1 million, do you spend 80% of it on salaries? Probably, possibly more. I feel like there's going to be some particular use cases where you're going to spend more on your processing, because what's going to happen is you're going to have really large data sets that you need to go through and process. On the flip side, it's quite possible you'll spend less because you might have quite a focused data set. So, if you're, say, a biotechnology company, and you might have, I don't know, let's say you're looking at people's smartwatches and pulling data from hundreds of millions of people on the smartwatches and trying to work out if they're having heart attacks or doing whatever, from some sort of analysis on it. Is your data set is big, like you've got terabytes of data, but it's not that big in terms of ChatGPT trying to process half the internet to work out its model. So I guess what I'm getting to is, some companies might spend more than 20%, but there'll be a bunch of companies as well that might only be spending 5% of their budget on actual processing power. So let's call it 20%. So we've got $200 billion extra. 20% of that's being spent on data. That gives us and data processing. So that gives us sort of $40 billion sort of new spend that needs to be covered. Now, let's say half of that gets spent on your hardware, and then, so because there's you're going to, so if you're going to go out and do this, there's other costs in terms of the people to run it, and your electricity, and all these other factors that go into it. And so so not all of that's hardware. So let's say half of that's hardware. Now I said half again on AI chips. That's probably being pretty optimistic for AI chips. So you've got to pay for your memory and your all the other bits and pieces that go into PCs. But let's say half of it ends up in AI chips, and that sort of gives you about 5% of that $200 billion. So that gives you about $10 billion of extra money going into AI chips. On an annual basis. That's a sort of going forward, and it'll probably grow a little bit or whatever. Having said that, maybe there's a bit of a rush for the first few years where you get lots, and then data centers actually have all this processing power, and now they can sell it back out to people, and there might be a bit of a rush to get AI processing up and running for a few years, and then it might die off a bit. But I guess if $10 billion was all it's coming through, well, that's actually already factored in pretty much. I mean, they're already talking about $4 billion a quarter. So my numbers must be out a little bit on that. There must be a bigger rush. or maybe some of it, more. There's a faster move forward. Like data centers actually need to invest a bit more now, but the spending will drop off faster. But I guess ballpark. I guess what I'm saying is it just doesn't look as if it doesn't look from this perspective that the market's that big. So so that's one way of looking at it. So let's try and look at it a different way. Oh, actually, sorry. And the other thing I said, in terms of 300 billion, if you had 3,000 companies spending $100 million each, the top 3,000 companies from the globe, like if you look right around the world and said, okay, what's the top 3,000 companies? By the time you get down to number 3,000, you're probably talking about $1 billion in market cap. So, if company number 3,000 was spending $100 million, that would actually be spending probably its entire profit and maybe more on AI. So that seems unlikely, but it's potential that unlisted companies, governments, and some of the bigger ones will take up, be spending billions of dollars and take up some of the average. But there's not a I guess what I'm saying is the numbers don't sort of obviously stand up to being sort of wildly low. So that's one way of doing it. I want to do it a different way to see whether we end up with the same types of numbers. And this time what I want to do is look at infrastructure spending by infrastructure spending on cloud computing. So if we sort of break that up in that direction, what you see is they sort of break it into three different areas. One is what's called telco capex. And that's so this is what data centers are out there spending, and cloud computing guys are out there spending every year to keep everything going. And so your telco capex, which is all your ADSL lines and fiber and all that type of stuff, is sort of running at that 250 billion and really hasn't changed for the last whatever number of years. And I would say that's unlikely to grow. That's unlikely to be a big part of the AI. Like most of the AI is going to be, the data is so big it'll get done on a data center and it won't be sort of moved. You're unlikely to be moving between data centers and spending lots of money on data. You're likely to gather all your data in one spot and then run all your analysis there. So that's unlikely to grow. Your enterprise IT infrastructure is sort of all the parts that goes around that to get to it. And then the one we're really focused on is this, what they call hyperscale capex. And that's the part about scaling up and running the PCs or running the servers to do the calculations. And that's the part that has been growing quite quickly. It's about 250 billion of spend at the moment by data centers. So if we look at that part and say, okay, they're currently spending about 200 billion on that part of it. Could they take that to 500 billion? So could they increase their spending could they double it plus 50%? And go, well, yeah, maybe, I suppose, over a period. I guess if we're talking about over a 3 or 4 year period, it's a pretty big ask, to go, we saw that the growth's been reasonable, but it's certainly within the realm of possibility and it's probably worth sort of a starting point for evaluation. So then you say, okay, so we're going to 500 billion in spend. That's going to add another 300 billion. Now, of that money, about half of it, a little bit more than half, goes to data centers, and the rest goes to sort of other factors of your warehousing and supply and staff and all these other bits and pieces that go into it. So let's call that 160 billion goes into your data centers. Data centers, make a decent margin, and especially if there's a lot of demand and everyone's trying to get AI. So I've said 30% margin. That's being generous. If there's a huge demand and people want double the processing, data centers might be making 50% margins. It could easily. I think I'm being quite conservative there, but so that sort of leaves you. So that gets rid of 50 odd billion worth of your money goes to the data center, and that sort of leaves you with about 110 billion dollars left to as we're sort of working our way down as what's left to spend on the servers. So. Then what's the data center's actual costs? Now they spend about 50 to 60% or 55 to 60% on servers. The rest goes on all their power and networking and infrastructure and all those bits. So you've got about 65 billion left to spend on your servers. How much the server is going to go into AI chips? Look, I've said 20%. Maybe it's higher. Maybe it's 30%, 40%. but traditionally it's been a big cost, but it hasn't been it hasn't been your overall cost. Your primary, like, it hasn't been more than 50%. And so that would give you somewhere between, say, 15 and 30 billion extra spend on AI chips. And so that's sort of basically, so it's a lot higher than the number we just spoke, but it's in the same sort of realm. We came out with $10 billion a year, which does look too low given NVIDIA's upgrades. 15 to 30, again, pretty good growth within that sector. But again, it's basically what they've already reported in terms of their upside. So net effect is the market's there. It's big, but and it's going to be huge, and it's going to grow really quickly. But how much of it will actually go into the chips, and how much of it will go into staff, and other factors around it? My bet is a lot more will be ending up in the staff. And the real example that I want to bring back is Cisco. Now, Cisco, I think, to me, feels like a similar type of company relative at the start of the internet. So we had this company, and Cisco does all the routers, and the whole idea was that they were selling the picks and shovels to everyone as the internet boomed. And this company would be the real beneficiary as the internet grew and all these proliferated. That these were the guys that were going to win out because of the highest quality and had the best routers. And that's largely been true for the last 25 years. If you look at their profit, great profit growth. I think in 1999, this is their forward profit growth. In 1999, they were earning, less than 40 cents in terms of earnings per share. Now it's like they're expecting $4 next year. So you get 10 times increase in their profitability over a 20-year period, which is pretty good. And it's been a pretty straight line up. There's been a few downturns, but it's a pretty good line. That's the type of company that you're like, yes, I'd like to buy that. It's solid, it's a good earner in terms of company. If you had invested in Cisco in 2000, you would still be down about 30% on your money, despite this profit growth. So if we look at a chart of Cisco, peaked at almost $80, and it's at $50 today. So the idea is Cisco's a great company. Like we own it within our portfolio now, but we bought it on 10 times. We didn't buy it on 100 times earnings that you would have done back in 1999 or 2000. Like the idea is there is a price to pay for everything. And Cisco is a very key is a very key part of the internet, and it's a very high quality company, and still gets looked upon as if you're buying a router, then Cisco is one of the first ones everyone will look at because of their quality. And NVIDIA feels the same way to me. Yes, high quality, good quality chips, all that type of stuff like that. But does the real power sit with NVIDIA, or does it sit with other players within the system? And my contention is it sits with other players in the system. I am more than happy to own NVIDIA at the right price. But paying 50 times what could be peak cycle earnings, it might be low. Maybe this thing will go to 100 or 200 or 300 times earnings. It could easily do. I don't know whether I'd want to be shorting NVIDIA, but in terms of getting a value for money, it's not the type of stock that I'd want to be putting into my portfolio at current levels. Love to have it at lower levels, but not at current levels. So we might go to. Actually, I think I've lost a few screens there. I had some. That's right. What I want to. Missing a slide there. What I want to talk about is your alternatives. So what you can invest in instead of NVIDIA. So there's a range of ones. We've got a couple of tilts you can do on our portfolios. So we have a robotics and an AI tilt, and we have a cloud computing tilt. So all those things I spoke about in terms of this growth in this sector, and how I was running the numbers through and talking about how much was going to end up. If what ends up with data centers. Data centers really do look like they're going to be one of the key beneficiaries of this. They make good margins. If there's a demand for more processing than what they can handle, and particularly in AI, then they will put their prices up to ration that. And so, I can very much see that, data centers could be one of the key beneficiaries. A company like Taiwanese Semiconductor, or actually not even a company like Taiwanese Semiconductor Manufacturing, TSMC, is going to grow because it's got, it produces this stuff for NVIDIA. And if competitors pop up, there's a pretty decent likelihood they'll be producing for those competitors as well. You've got companies like ASML that makes the machines that TSMC uses that go into this. That's again another type of company where they're a lot more stable in terms of the margins. I think the moats are broader. They're not as cyclical. They're still part of the same sector, but not as cyclical, and they are going to benefit from the demand you get from NVIDIA and the demand from others if NVIDIA ever loses its market leadership. There's within that cloud computing space, the big ones, Alphabet, Amazon, Microsoft. There are a range of smaller ones. So within our tilts and screens, you can sort of jump on and grab some of those. Within the robotics and AI, we do have NVIDIA within that part of it. There's also a bunch of other companies, ones like that are involved in robotics as well as some of the AI. So Intuitive Surgical does robotic surgeries and sells machines around that. And so that's the type of company you can sort of pick up within those, or for Nuke Corp or SMC that sort of run a lot of the connections between robots and computers and run a lot of the systems behind those. ABB, one of the world's largest robotics manufacturers. A whole bunch of companies within those screens and tilts. Then within our active portfolios, we have sort of certain ones as well, which we pick up with exposure to these. So we do have access to most of the data centers. We've got exposure as well to some of these robotics companies and ones that we think are going to are more attractively priced within ours. So that's those. Let's go to the question of the week, and then I'll do the investment roundup on the types of stocks, the broader picture types of stocks you should be looking for.
Okay, so now we have the question of the week. This is for viewers to have some discussion in the comment section over the coming days. The question for this week is NVIDIA at the start of a boom or in the middle of a bubble? So feel free to post your thoughts and engage with us and some of the other viewers over the coming days. And Damo, back to you for investment implications.
Yes, so I want to come back to the same thoughts we had last time behind the... So for anyone who hasn't listened to our AI sort of podcast, what we did was we looked at a lot at who's going to suffer and who's going to benefit. And in terms of benefiting, same story, big tech, cloud computing, chip makers are your big ones. And I don't want to say NVIDIA is not benefiting. They are definitely benefiting from this. It's just a question about saying, where am I paying for, and what's the, at what stage do I decide that too much is I don't want to run into the Cisco problem. We want quality stocks, monopolies and oligopolies. They're the ones that are going to have the pricing power where basically if a company becomes more productive, there's a few different ways that's going to get filtered out. Sometimes that'll get filtered out as to more profit for the company. So I become 20% more, can cut 20% of my costs out, and I've got lots of pricing power. Right, I'll keep charging that money and I'll make stacks more profit. Another company which doesn't have the pricing power because they're in a highly competitive sector, they cut their costs by 20%. All their competitors all do the same. All the competitors start cutting their prices to pick up market share. They have to cut their market prices to pick up market share, and the consumers are the real beneficiaries. There'll be other companies out there where we spoke about some lawyers and doctors, where what you might find, say, for a lawyer is a lawyer had 3 different assistants that he'd say, go and write me up this type of contract and go and do this part of it and go do this part of it and then bring it all back. And then, the 3 assistants have done 80% each, and he puts it all together and then fixes up their mistakes and then puts it out. A lot of that will be done by AI. He might be able to fire a couple of those. And then the question is, does that lawyer have enough power within the business to actually charge much higher rates, and actually, does the benefit accrue to a higher salary to the higher valued employees? And so that might be the case in some of them. So, but if you can find these quality stocks, the ones with monopolies, oligopolies, high margins, ability to, a shown ability over time to maintain those margins, then they're the ones that are going to really benefit from productivity gains, because they're the ones that will be able to hold on to the prices and get the higher prices. Healthcare and high service cost businesses, if you're in a higher service cost business, there's a reasonable chance that you'll be able to cut some of your costs through AI. Defense stocks, there's certainly a lot of money going to be spent on defense within this. And then the final one, that interest rate sensitive in terms of benefiting, is this idea that, well, if AI is going to be particularly good and particularly is going to really drive some productivity gains, then that probably means lower inflation, and it probably means, especially in the service sector industry, and so potentially means lower interest rates as well. On the flip side, value stocks, the cheapest stocks tend not to be able to have that much pricing power, so they're the ones that generally will get hit. Intermediaries, there's still some sectors where intermediaries are left. The internet got rid of a lot of intermediaries, just sort of cut them out of the equation in terms of people could react. Say travel agents, I no longer needed to go through a travel agent most of the time to get to where I wanted to go. The internet cut off most of those. AI is going to finish off, a lot of the remaining ones. Whatever's left. I'd be nervous. I'd be certainly, if the business model is basically buying from one person and selling to another, you want to be sort of trying to work out, how stable that is and what the real threats are. And then, these idea of broadly competitive industries and disruptable industries that I ran through a whole bunch of ones that, have, I guess, issues in terms of, will the industry be around, post this? So, if you're a copywriter, for example, you just might not have might no longer be the demand for you. So say in advertising, for example, there may be a large part of it that can be disrupted, and you're sort of left with a few individuals rather than sort of big advertising companies that are running this. So lots of different ones, and I guess I'll point to that other video for a broader of the disruptable sectors, but lots for people to think about in those investment views.
Yeah, and Damo, I just want to touch on the screens and tilts again and throw out a couple of ideas of how people can play this AI theme within the Nucleus Wealth portfolios. So with the screens, you could exclude the GICS sector information technology stocks. So that's going to exclude all the IT stocks in that category. And then with the tilts, you can include these as tilts within your portfolio or as a standalone portfolio. So there's the obvious one, the robotics AI tilt or portfolio if you want. And then the other ones, there's the cloud computing, which you touched on. There's also large technology stocks. And then you could throw in a cybersecurity tilt just for a bit of fun. So that pretty much wraps us up for today. So Damo, thank you as always. Very captivating story. I'm sure it's going to be interesting to see how this one unfolds over the coming months and years.
Thanks, Sam.
Excellent. So if you enjoy our content, subscribe to our YouTube channel now, like the video and click the bell below to make sure you don't miss out on any special episodes and future content. Also, if you know of anyone that might get some value out of today's episode, we'd really appreciate it if you do share it with them. We do put out a lot of other content in addition to this podcast. We have regular articles that are featured in First Links, Livewire, and we've also been written up in the AFR and the Australian and lots of other major publications. To get all this, subscribe to our weekly Nucleus news and investment insights at nucleuswealth.com. We do welcome your feedback in regards to this podcast, especially for future topics. If you do have any ideas, drop it in the comment section below or send us an email to contact@nucleuswealth.com. Also, if you'd like to look at the slides in more detail, we'll post them in the show notes this afternoon, and you can view these at nucleuswealth.com/webinars. So from myself, Damien, and the rest of the team at Nucleus Wealth, thanks for watching, and we look forward to seeing you next week. Bye for now.